We've just had the PMI data out, 51.2, which was in line with the previous month and above estimates. And it's in line with your view, which is one of a broadly positive view of the Chinese economy.
Yeah, absolutely. I think what is happening is over the last few months, people are underestimating the role of external demand in stabilizing growth in China. So while China is tightening and slowing domestic demand, at the same time you are seeing this pickup in exports that's helping to stabilize. And that's what exactly is showing up in this PMI number too, that actually the new export orders ticked up a bit and held stable.
And exports, you're positive on those as well for China. You say this year, 2017, could be the strongest year for exports since 2012, and that ties into this demand picture as well.
Yeah, absolutely. I think this is the first time that we are seeing this synchronous recovery in global demand. So both EM and DM are doing well. In DMs, we are seeing that they are not deleveraging anymore. The private sector in EMs, we had 4 years of adjustment, first in commodity importers and then commodity exporters. So that's really helping the external demand. If you look at the number in terms of magnitude of recovery that we've seen in external demand, since October 2016, EMX China's exports have gone up by about 11% in volume terms cumulatively. We think that's a very strong growth in external demand that you're seeing right now.
Have any of your assumptions about what we're seeing going forward for the Chinese economy been shaken by the deleveraging campaign that we've seen? We've seen the pressure on bonds, Chinese bond yields, and the impact on the equity market as well. How much of a concern is that? Do you expect the deleveraging campaign to continue at the same pace? And how does that play out in the bond markets particularly?
Well, I think they're watching two things in terms of the pace of managing this deleveraging. First is the interbank rate. If interbank rate really spike up big time, I think they'll have to put in some liquidity and then stall this pace of deleveraging. And then the second thing is what's happening to external demand. Because remember, China's model is counter-cyclical growth management. The key reason why the debt buildup has happened and the debt has been so big is since 2011, external demand had been declining. And so China has been trying to create domestic demand through leverage. But now if you have external demand recovery, you can pull back on this leverage. But if suppose something happens in the US and you get a global downturn and exports weaken again, I think that will also shake their ability to take down this leverage pace.
And Moody's obviously going ahead with their surprise downgrade, and that angered the Chinese, of course. They said they were misreading the situation here in China. What's your view on that downgrade? Was it fair? Was it accurate? Was it the right time?
Well, I think the big debate about that downgrade is debt to GDP management. And we are quite constructive that China will be able to stabilize the pace at which the debt to GDP is rising. And that goes to the fact that, there are 2-3 things which are different this time. First is that external demand is recovering after 6-7 years of deceleration. Second is China's property market condition is far more healthier. Today what we have is housing starts are higher than housing sales and inventory is already declining versus what happened in 2013 to 15 when they were tightening. Housing inventory levels were high, housing sales were weak relative to starts. So we have the exact opposite. So property market is far more healthier. And then the third thing is that China has over the last 3 years taken down some of the excess capacities. And that's helping the overall pricing power. So because of that, you have a nominal GDP growth, which is much better. And you don't have the challenge where nominal GDP growth is 6.5% and debt growth is very strong. The debt to GDP will keep rising. So our view is that debt to GDP pace in this calendar year in 2017, rise will be more close to 10%, and next year will be more closer to 5% rise in debt to GDP. That will give the comfort to investors that China is able to manage this soft landing.
A lot of this, of course, and the positivity, the bulls, the perma bulls on China point to, the conditions are that the reform process and the reforms are going to be put in place. Obviously, many would say it's been glacial at best. In some circumstances, the reforms have taken a step back. You look at the state-owned enterprises, for example. That hasn't moved forward. Are you expecting to see a pickup in reforms after the party congress towards the end of this year?
Well, I think that's the one area where we think there will be a more moderate pace of SOE sector is where the reforms will be relatively slow. But the other areas in terms of transition to higher value-added economic activities, for example, if you look at the share of China's exports today, more than 50% is higher value-added exports, which was about 5 years back just about 25%. So that transition towards higher value-added manufacturing, for example, is happening. Transition from investment-driven growth to consumption-driven growth is happening. Transition to more services output from manufacturing, that is also happening. So a lot of other reforms are happening, but SOE1 we think will be relatively slow. And on SOE, I think what you will see is improvement in efficiency of SOE's operation rather than large-scale privatization like you see in the other parts of the world.